The following was recorded in front of a live studio audience at the Studio 21 Podcast Cafe. This is the United Podcast Network.
Welcome to Easy Money New England.
Oh, can somebody help us here?
We can, because we are real estate and mortgage professionals.
Where you go? It says come in and browse.
That's right. Come on in, listen up, and learn.
How long do you intend to browse?
In a short period of time, our panel will teach you some tricks that might make your house buying easier.
You don't ask her how long she intends to browse.
You might not be looking for a mortgage today, but we'll get you ready.
You don't look like browsers.
Are you looking?
No, what do browsers look like?
Yeah, maybe I'm half browse.
On his father's side.
This is Easy Money New England
Let's show the lady we're browse.
with your host, Brian Damico.
Hey, look at us, we're browse. One more word out of you and he gets it, all right? Come on.
Hello. Welcome to Easy Money New England. This week we have on the show John Marroni. John Marroni is a mortgage originator, has been in this business a very long time. And, this week's episode is really based around the mortgage process. So typically we go through money making or money saving ideas throughout our show, but you have to borrow money to make money. So going through this mortgage process is very important to getting you on the right track. So John,
Yes.
Welcome to the show.
Thanks for having me.
So John, John is a loan originator at New Fed Mortgage, and we've known each other for years. And John, you actually owned your own mortgage shop back in the day too.
For 13 years.
For 13 years.
Yep.
For all the regulation folks, John's NMLS number 5778, Brian Damico's NMLS number 20400, and New Fed Mortgage 1881. Always want to start the show that way.
Yep. Absolutely.
So, John, you've been in the business how long now?
22 years.
So you've seen the ups, you've seen the downs, you've seen different types of mortgage programs. I mean, pretty much seen it all.
Absolutely. Few cycles.
So, with that, you've seen, the process inside and out. So if I'm a borrower or I'm a consumer and I'm driving around right now, I'm listening to the show, I might be in front of I might be in my living room. What are the most important things? I want to buy a house. I want to be, if it's a first time buyer or someone going through the process today, what are the important things that they need to know?
So to answer that, I'll just say, being in the business 22 years, before that I was an engineer, working on the Patriot missile. And part of my job there was, to help with improving the process.
We might need that today soon too.
Yep. So being in the field for 22 years, I think the mortgage industry has done a terrific job of taking something very simple and complicated and confusing people.
I can agree with that.
So I've decided to reel it back and say, okay, when someone calls me, what do I do? Well, I call it breaking the ice. That's an acronym.
Breaking the ice.
I break the ice.
I used to have a game like that, breaking the ice, as a kid.
Yes.
You ever remember that one?
I remember that. I remember that. Except this game you can win. So ICE, it's an acronym, I.C.E. Income, credit, equity. So income, we want to know where your income comes from. As a matter of fact, you do not need a job to get a mortgage.
Boy, wait. You don't need a job to get a mortgage?
You never needed to have a job to get a mortgage. You needed income. So income can come from all sorts of places. Like if you own a bunch of property and you get rental income, that counts. You can get pension, Social Security, child support, alimony, notes receivables. The list goes on. So as long as you have income and you can demonstrate that you will receive it for the next 3 years, you'll be able to use that income.
So my wife pays me to be a house husband. Would that count?
As long as she can guarantee that you'll get it for the next 3 years, yes.
Perfect.
Absolutely.
And do you actually put that on your tax return?
Should I not? Is it less manly?
I think there was someone on Big Brother that was that. Who was that? Just recently. Who was the guy from Boston? He was. They said he was a stay-home dad.
As long as you're claiming it, you can use it.
Absolutely. So the next part of the ICE is the C. That's the credit.
Credit. All right. So we could talk forever about credit.
Yeah. So basically, people they want to take a look at the credit report. They're really looking at how you pay your bills. As a matter of fact, when you look at a credit report, it's almost like someone's personality behavioral profile. You just know how people are going to pay their bills. There are some people I look at them and I say, look, based on your credit report, there's really nothing I can do for you right now. But based on your credit report, you look like you'd be fun to hang out with. That's all I can tell you.
But you could actually coach them to get in the right position to then be able to buy a house.
Absolutely.
And you do that a lot.
Yeah, as a matter of fact, I had someone that I was looking on his credit report. He made plenty of money, but he had all these foreclosures, houses that were in foreclosure. He owned these 3 families that was income producing properties, and I'm trying to figure out, why is this guy in trouble? I said, you need to come into the office because I need to see what your vice is. And so the moment he walked through the door, it was like this shining light. There was my answer. The guy, he had a baseball hat on and a T-shirt. Both said Foxwoods Gambling Casino. And I said, there's my answer. And, what struck me the most was like on the back of his shirt. That, he must never have read the back of his shirt, even when he took it out of the wash. He probably would have not gotten into trouble because the front of the shirt said Foxwoods Casino. The back of the shirt said, the house always wins.
Yeah, that's I know a few people like that, and
yeah.
But I mean, getting back on the credit report itself, I mean, a lot of people don't know. Like, for example, if I have a $5,000 limit on, say, a MasterCard, and the balance is $4,800, that is going to keep your score a little lower because of the percentage of what you use on the credit that you have outstanding.
Right.
And I see a lot of times when that's just, say, 20% of that balance, the score's jumping up.
Absolutely. Yeah, it's like 30% is the magic. Where people get confused is, let's say they have 3 credit cards and they're $10,000 each. So they say, all right, I'm going to pay off this one first, then I'll pay off the second, and then pay off the third. The better strategy is to do them all at the same time. Because if, let's say you pay off one credit card and you still get the other 2 that have higher percentage of balance versus available credit, it's not going to do much for your score.
Right, for credit score related. But if, in fact, one was much higher interest rate, then maybe they would do it that way. But if they're all equal interest rates,
that's right.
Obviously, you want to, whatever you have that's credit worthy, if for credit score driven, I mean, you definitely want to keep that balance not right near the max.
That's right.
I see it a ton is, Home Depot, they were late 30 days.
Mm-hmm.
I think that happens a lot.
How long does it take to repair someone's credit? When you look at their credit score and you can see that they're in trouble, how long would it take to turn that around and make them a viable prospect?
It depends on what it is. I'll give you a worst case scenario. I would say if someone had a foreclosure 3 years ago and a bankruptcy 2 years ago, we could get them a mortgage FHA. So in other words, if they're in the middle of all that right now, it will take 2 years. That's worst case. That's assuming they reestablish themselves. So let's say someone goes through a bankruptcy and gets discharged. The first thing you want to do is open up even small, secure credit cards to reestablish yourself. In fact, the day that your bankruptcy is discharged, the average person's credit score shoots up 94 points.
Wow.
Yeah, and that's because at that moment that you have 0 delinquencies. And,
that's interesting.
Yeah, it is.
There are some programs out there that are even shorter, but those are considered portfolio programs. You got to have a big down payment. Not really, interest rates really not great. So, I mean, really, FHA is, I think, the best one. We wait in 2 years to come out of that.
Right. And typically, they'll say 1 year if it's an extenuating circumstance. So extenuating circumstance can be like medical, maybe loss of job. I know sometimes people will say, well, I went through a divorce. And people say, well, that's not extenuating circumstance. That was a choice. You chose to be happy. So,
you're going to be in trouble for that one.
What Groucho Marx used to say. He goes, "Are you happy or are you married?"
All right. So we talked about let's say I.C.E. income. So you're saying you don't have to have a job, but if you do have a job, I mean, definitely W-2 income. You want to be at the same job, stable 2 years. If you're self-employed. What if you're self-employed in the income section?
So self-employed, we want to look at the 2 years tax returns, and we average the income. Assuming if the income, say 2016, is more than 2015, we'll average it. If it's the other way around, we'll take the lower year. Plus, they're going to want to know why the income declined as well. It's not so we can't. The underwriter wants to make sure you're not getting in trouble. With your business.
So self-employed income, and then and then we talked about credit. the last piece of this is equity. I mean, so if you're buying a home or you're refinancing a home, what's the difference
So if you
when it comes to equity?
all right, so I'll start with the refinance. If refinance is, let's say you owe $300,000, you got to get the house appraised. Depending on the value, that will determine your rate. So two pieces that determines your rate is your credit score and the loan to value, the equity position. So if your house appraises at $400,000 and you owe $300,000, that's what they call a 75 loan to value.
That's quick math. I would need to calculate it.
Yeah, I practiced on the way.
Right, Jonathan? So does that make sense to you? Equity, right? So loan to value is the percentage, but did you follow that one?
Honestly, I was switching some transitions up here. I'm sorry. I can't pay attention to the show the whole time while I'm paying attention to the back end.
But loan to value is really the secret. That's the lingo in our business. What's the LTV?
Okay.
Very important if a customer knows what their loan to value is. So when someone calls on a refinance and they say, hey, the first question is, well, how much do you think the house is worth? And how much do you owe? By those two things, you divide them up, you're going to know what their loan to value is, and that's going to really dictate what type of program that you're looking to put them in.
Does having an appraisal at that point have any value to get if there's been a change in equity because of the market?
Well, the appraisal, when it comes down to the appraisal, appraisal is pretty much on the equity subject as well.
Yep.
They're going to have to go out, research a property. How do they come up with the value, John?
They base it on what's similar homes that have recently sold in the last 3 months, preferably. If they have to go out 6 months, they will. The rural towns become challenging because sometimes there's not enough comps and they might have to leave the area, different town, and then they really have to explain why they feel that that's the value. It becomes a real subjective at that point.
Yeah, so it's basically on square footage, right? So if something is valued square footage wise similar, a lot of times I hear someone say, "Oh, but the house, down the street just sold for $600,000 and mine's so much better." I'm like, well, is it bigger or is it smaller? Well, mine's smaller, but it's better. Well, 9 times out of 10, you're not going to get that same value because your house is smaller versus the house that was much
So
bigger.
really, it does come down to square footage. It's not whether or not you have granite countertops or tiled bathroom.
That's true. Yeah, and here's the thing about square footage where a lot of people get tripped up.
Yeah.
Let's say someone spends $100,000 to finish their basement and they put a couple bedrooms down there, maybe, really granite countertops, the whole thing. The appraiser's not going to add any value to that, or very little. The town will. The town, when they assess it, they'll call it livable space. But the appraiser, anything below grade, they're not going to count that. So what happens is if there's 2 bedrooms upstairs, 2 downstairs, he's going to call it a 2-bedroom. I have one going
below grade.
Yeah. And like if you look at split level appraisals, they you'll see the square footage. It'll say 900 square feet. You're like, what are you talking about? I know it's 1,800. No, because it's below grade, even though half of it goes right out to the backyard. I have conversations with people with that all the time.
Yeah, like they think their house is worth so much. They'll go to Zillow, they'll see what the value is there. Sometimes it's accurate, sometimes it's not. But it does pull up the most recent comps in the area, so it's a good place to start.
Yeah.
Go ahead.
No, so you want to switch to the purchase?
Yeah. So purchases, right? So on a refinance, if you say your house is worth $400 and you owe $200, you're at a 50% loan to value.
Yep.
If we go into the purchase market now, this is where it gets interesting, right? Because, many consumers, many borrowers, they want to buy a house with as less money down as possible some of the time. And because the myth is that you need 20% to buy a house. Well, that just isn't true. So talk about, if you put 5% down, that's a 95 at loan to value.
Right. So it depends on, at that point, it depends on what your objective is. Some people might want to hold on to their money. There are parts of the country that they insist on no money down. I know, like down in Pennsylvania, a lot of those folks have the farmer mentality where they just hold on to their money and they do the USDA loans where it's a no money down program, even though they have the money to put that down. Because their thing is, we want to hold on to our money. Cash is king.
Well, we're at the Studio 21 Podcast Cafe in Salem, New Hampshire, and a lot of New Hampshire is in the USDA territory.
Yeah.
And it's also down in the Cape Cod area. A lot of USDA properties. You could actually get into a property with no money down using that program.
Absolutely. So and the other thing too is a lot of times people say I want to put down as much money as I can so I could lower my payment. So it's not so much putting down the money that lowers the payment. I mean, for like every $10,000 on your mortgage, that translates to about $50 a month based on today's rates.
Yeah, let's talk about that. So, I mean, a lot of times people call me and they say, I want to put down 20%, and relatively that's a good idea because there's no mortgage insurance, right? So, but if someone wants to put down, the difference between 10% and 20% or 5% and 10%, there's not a big savings there. What would you say that the average savings, if I want to put down 5% versus 10%, where's the difference?
It's probably $75 a month.
Yeah, and that's based off of
today's rates and
median loan amount.
Yeah, figure like 300,000 versus 285.
Yeah. So obviously we put the information in the computer. We kind of take a look at it, but when you do review it with a customer, you say, hey, look, if you wanted to put down more, it's not gonna give you the big difference. And what does make a difference is the amortization schedule, right? So if you're going from a 30-year to a 20-year or a 15-year, huge differences there.
Yeah, absolutely. It's funny. I just talked to a person yesterday. His credit score wasn't the best, but he was like in that area where if you put 20% down, he was like what we call the high balance. Like in our area, it's above 424,000. So he was going to put 20% down, and I looked at the rate, and his rate was like 5%. And I told him, I said, hey, listen, if you put down an extra, $20,000, we'll get you down to 424, and I can have your rate at 4.5. He's like, what's the difference? I told him, he's like, no. He goes, I'll take the higher rate. I want to hold on to my money just in case I, need to like do some renovations to the house or whatever. So to him, like keeping the cash was king, and he got a monthly payment. He's like, all right. He goes, even if it's $100 a month difference, he goes, I don't care.
Right, because I mean, really, it's tax deductible.
Yep.
I mean, I don't see that changing anytime soon. All of your mortgage payments are all the interest is tax deductible. So, that conversation, we had someone that came in the other day and he said, I'm paying $1,800 a month in rent. Why would I buy a house? Even if it's $2,000 a month to buy a house, why would I do it? And like the first thing that comes to mind is, well, it's tax deductible. You're basically throwing your money out the window when you rent it.
Yeah, in fact, I talk about that. It's called after-tax dollars. So, some people that are making good money, and they'll say, all right, I want $2,000 a month to be my cap. And then I said, all right, so right now you have no tax write-offs. And then, based on your tax bracket, if your total mortgage payment was $2,600 a month, after-tax dollars, that brings it down to $2,000 a month. Quick disclaimer: check with your tax professional.
Yeah, right.
So they see that. So some people say, all right, I can live with that. And then, because at the end of the year, you're going to be getting that much extra money back. So it offsets.
Yeah.
And I go through that with them.
I think, it's a huge difference. Jonathan.
Does having the market be in a buyer mode or a seller's mode affect how easy it is to get a loan?
No.
It doesn't change anything.
It's really numbers, right? So it's that appraisal is going to dictate the market based on value. Obviously there's ups and downs, seller markets versus buyers markets. Some people, I know today there's a lot of people putting offers in, and there could be 6 or 7 offers. They got to decide which one's the strongest offer or which one they want to sell to.
Yeah, because even today, you could the extreme is downtown Boston. It's clearly a seller's market. You got cash buyers outbidding cash buyers. You go 50 miles west to Leominster, it's the opposite.
Right.
It's a true buyer's market.
You spent some time in Leominster.
I have.
Yeah.
And I had someone just bought a single family in Athol, Massachusetts, for $130,000, and he was irate that he paid too much.
Yeah. So I mean, it's all weird. It's they say location.
Right. So to answer your question, same year, same month. I have a borrower that bought in a buyer's market, and we have someone that bought in a seller's market. So the underwriter looks at it both the same.
Right. They're just looking at that value and basically the loan to value, which we talked about.
Yeah.
And then obviously they look at income, like you said, the ICE.
Right.
Income, credit, equity.
Yeah. So in terms of the equity portion, the down payment, now the underwriter looks, okay, where does that money come from? So it can be a gift from a relative, and depending on the program. Let's say you have cash, and all of a sudden you throw it into your bank. Well, that's going to be a problem because the underwriter's going to want to know where that came from. So when someone comes to me early enough, this is where you start what I call getting mortgage ready. We look at the last 2 months, most recent 2 months bank statements.
Right. So let's talk about, what not to do, right? So
Sure.
So we kind of reviewed income, credit, equity, kind of touched on every one of them so you understand what kind of an underwriter looks at. I mean, we didn't talk about much about income, your debt to income ratios, and that's really what a loan officer and an underwriter looks at is, how much is the percentage of what they're making is how much they can spend. And we could talk a while about that, but we won't get into too much of the specifics. But just know that income and debt to income ratios, if you search that, you'll understand it. Credit, equity. But, once you're in process, what are some of the things that you shouldn't be doing? I mean, because it's such, like you said, it's a very complicated. They made it very complicated that anything that changes during the process is a major, hurdle to get over.
Yeah. So, we know that people have to live their lives. People can't just stop everything, especially if someone has a job opportunity, take it. But you want to tell us ahead, give us a heads up that something may be coming along the line. Because now, let's say you're going to get a job, and we could take the offer letter. As long as you start within 59 days of closing,
right? We
can use that future income that you're going to make.
Yeah. So number one is don't change jobs in the middle of the process.
Right. And if you do, just let us know.
Let us know beforehand, before it goes to closing, and they're trying to schedule a closing, and then they find out that. What we do is a verification of employment at the end. And
right.
If that person says, "Oh, and this does happen. So and so doesn't work here anymore."
Right.
Oh, well, what happened? So that could push your closing date off a little bit.
Right. And then I've had that happen to me a couple times, and then the person said, "Oh yeah, I just got a new job."
Yeah.
Isn't that exciting? I said, "Yeah."
How far in advance should somebody be sitting down with one of you before they're ready to make the purchase to get their affairs in order? It sounds like not that it's a very involved process, very time consuming long term, but it does sound like there are some hurdles that could be avoided if somebody were to have a conversation.
Yeah,
first.
if it was, if you have a perfect borrower, you don't need much time. We can just start right away, before they make the offer, run it through the system, make sure everything works. But if you have someone it's going to be complicated and they have cash all over the place, I would say like 90 days before you even think.
Yeah, I mean, there's some different schools of thought, right? A lot of people don't really look at mortgage until they already found the house that they like. And that's, people kind of do that. And, we understand that happens. But if you become much more educated and understand what the mortgage person is looking for, it's much better off starting off early with the mortgage person and then going to find the house. Because, as you get pre-qualified or pre-approved, you can send us the address that you're looking at, and we'll break down the payments to the penny of what it would be, versus you really not knowing what your payments would be, where you want to be, what your goals are, how much do you want to spend. If you're kind of backtracking and starting with the house, I believe that's, it's a lot of wasted time. And then, there's some people that, hey, I'm putting 20% down. Why do I have to go through this process? I have plenty of money. I've seen a lot of people that get declined even though they have a lot of money in the bank. It's because, they may have capital gains income, or they're not showing enough money. They may be a real estate investor and they're not showing enough money that they're making on their properties because they write a lot of stuff off, which is very common.
Yep.
And they can't understand why they would get declined, or they can't understand why the underwriter is asking what they're asking for. And that's another. I know, John, you had someone like that recently.
I sure did.
But it made a lot of sense to him. I can understand why he was like, why? But at the same time, the question was, when was the last time you got a mortgage? And he said 20 years ago.
Yeah.
It's a different process today. It's just much more prudent to go through this in the beginning than waiting. And I think that, so John, if someone wants to start the process with you, how do they reach you?
They could just Google me.
Google you?
Just Google me. You'll see me. John Marroni. JohnMarroni.
That's right. John does have a great Google presence, and you'll see all his testimonials. People can't say enough about him. He does a great job.
Yeah, they wrote those themselves. I didn't coach them.
Yeah, I mean, Google's really good at not being able to put any fake ones down. Right? It's pretty good.
No.
But getting back to things not to do. Right.
Yep.
So don't change jobs. a lot of don't misrepresent yourself. I mean, I think a lot of times people don't realize that if you're paying alimony or you're paying child support, you got to let us know.
We'll find out.
Yeah, it might happen later on in the transaction,
Right.
and then you really, you're running up against it. That's what happens.
Yeah, and if you have, if you have property, whether it's in Florida or in Vegas, let us know about it, even if you don't have a mortgage on it. A lot of times people assume they don't have to tell us because they don't have a mortgage.
That pops up late a lot.
Yep.
And, you still have to debt you just for the taxes or the insurance.
That's right.
Even though you don't have a mortgage, it's very important to let us know about that because it's just going to cloudy up because some people say, how quick can you close? Well, how quick can you give us the information? I mean,
That's right.
Really
it sounds like the more accurate the information, the quicker that you can get through the process.
Yeah.
Because it sounds like it's all coming out in the end.
Yes.
Can people keep secrets from you
No.
all the way through?
Today's day and age is very difficult.
I'm not saying you guys are PIs or anything, but just
Well, no, this business is making you very, very much like that, right?
Yeah.
So we have what's called a fraud guard. So we run fraud guards on every single person that comes in the door. So it will question, what are these last 6 addresses that are under your name? And that's a condition. Like, what address, what is this about? What is this about? What is this about? It also runs them through another, if they own any other properties, it's going to list what they think that they own. And then if they say they don't own them, you got to prove it.
Yep.
So, it will scrub their work history. It's a very detailed report. And that's, back in 2006, 2007, and before that, these reports weren't required.
No.
So the market's changed quite a bit, and it's for the better. It's good to know up front what we get to work with.
Yeah, just to give you an idea how much it's changed. I mean, we had the most extreme product was a 4-family, 5% down. We didn't ask where the money came from. We didn't ask any income questions. We didn't even ask if you had a job. As long as you had a 620 credit score, you got well, I pulled out a mirror, made sure you fog it.
They were exotic programs, so it was only fixed for 2 years, and then they were adjusted. And we could talk about the reasons why this economy crashed back then, but that was a major part of it.
And along that line, even today, I've always done it back then, is people say, how much can I qualify for? And I say, let's back up. How much do you want to pay per month? I mean, chances are I could probably qualify more than what you want to spend.
Right. And you definitely want to back into that payment.
Yeah.
I think that's much smarter because you don't want to, you can say, hey, look, you can, you don't want, if your wife knew you qualify for a lot more, she'd probably buy more house. Right?
Absolutely. Yeah. And it's like, and I went through that with someone. They were looking for houses in Peabody, Massachusetts. And I'll throw out a number. He said it was like $2,000 a month. And he goes, oh, I just found this house, same price in Swampscott, but his taxes would double.
Yeah.
And I just said, instead of $2,000, now you're up to $2,400. He's like, whoa.
Right. Taxes are huge. And that's why, when you get pre-qualified or pre-approved, it's important to give us the address up front, that you're looking at, because we can give you the payment so you're not shocked that, oh, geez, I thought I was going to be at $2,000 or $2,400.
Right. And I'm glad I had that conversation because he said, all right, I'm not going to put an offer in that house.
Yep.
The worst thing is putting an offer in, everybody gets excited, gets accepted, everybody gets excited, and then now you have to backtrack or, people start not being as excited as they were, prior.
So, going back to things of what not to do.
Yep.
I mean, don't pay bills late, right? I mean, that's a big one. I mean, it's, where we run what's called a refresh credit 10 days before closing is the maximum you can go out. So sometimes it's 7 days, sometimes it's 5 days. We're running that before closing. So if something pops up from the day we pulled your credit report versus 10 days before closing, again, we're going to know about it.
Yeah.
And that's, FHA does not require that, but conventional does. But, it's definitely, we still do it on both because we want to make sure no one's buying another property or something like that. It's important to know.
And even if you are going to buy another property, again, if you make plenty of money, you can do that, but just let us know so that we have to account for that into the income calculation.
Yeah, I mean, even if you paid off some debt and, it's 7 days before closing, they paid off some debt, well, we got to show where it came from, right?
Yeah.
So we just got the paper trail. So as long as you have a good paper trail, you're paying it by check, not by cash. Very simple to kind of accommodate that. That's not a big deal. But yeah, it's just we need to know about it. And then, a lot of times people go out and they buy furniture before they close.
They sure do. They get all
I've seen that quite a bit. So, I mean,
Furniture on a credit card?
On a credit card. So, right before closing, you pop up that, the zero balance credit card is now, $7,000-8,000 worth in debt. If you had room, then it's okay. But if it's a tight deal, we need to know about that.
That's the place to use your mattress money. Don't deposit it in the account. Go buy your furniture in cash.
Perfect. That's right.
I don't know. I don't know about mattress money.
I say that I had a friend that almost lost a deal because he had $10,000 in cash literally under his mattress.
Yep.
And he pulled it out because he realized that he needed money for his lawyer or whatever it was, and he was going to write a check.
Yep.
And dumped it into his account, and it froze everything.
Yep.
Almost ruined the deal.
Right, because you have to source and season where that money came from. And again, John was saying it's 2 months, right? 2 months bank statements. We need to see 2 months when you, and then the time that you give that deposit check to the realtor, we get to see you clearing the account, right? So we could talk about that a little bit. I mean, when they pay their deposit money, make sure they have a record of that.
Absolutely. Yeah.
I know some people. I know that some people have $1,000 of cash on an offer. Yeah, you have to back that out,
That's
and
right.
then you have to bring in a new one. I mean, it's just, the reason for the show is to cut through all the hurdles and just go smooth sailing.
Right. I mean, in the perfect world, we have 2 months bank statements. The money's already in there. We look at the beginning balances, plenty of money, and you just, you don't have tons of money, large deposits that you can't explain.
How big is a large deposit that would be difficult to explain?
It depends on what they make, right? Isn't it?
Right. So there's a percentage of what they make. I believe if it's less than 25% of their income
For the year?
Month.
For the month. Okay.
Right. So yeah. So 9 times out of 10, you're going to be, if you have a $5,000 deposit, you're probably going to be asking for it. Like,
got some
where
explaining
does
to do.
5,000 come from? So just keep good records. I mean, it's
And it's aggregate. So if you have like 1,000 deposit,
right.
that counts as one $5,000 deposit.
Right. So if you're listening to him like, oh, I got a way to get around this. I'm going to put $1,000 in every day for 5 days.
Yeah.
It looks like a pad, and
a
underwriter's
layer.
going to ask for it. It's not, you're not fooling anybody.
We call it layering.
Yeah.
It has its own nickname.
Yeah.
So one of the things I want to mention about when disclosing everything to the loan officer, sometimes when you do, it actually helps you. Because I had a situation where I had a guy that was he was buying a house, single family, and I had to go FHA with him based on his credit, and his debt ratio was very high. I was trying to figure out some income, and he's like, he's putting 3.5% down. And so finally, I'm looking at his bank statements, and I see this deposit from the VA, disability. And I'm like, what's this? And he's like, oh, I get disability from, I go, you're a veteran? He's like, yeah. And I go, why didn't you tell me about this? He's like, well, I was a little embarrassed about it. I go, not only can I use this income, but I can get you into this house with no money down now.
Right.
So
for all you veterans out there, we should be doing much better than no money down and a much better program.
Yeah.
But it's out there. So,
right. So it's like, and we ended up going VA with him and no money down. He's thrilled. Had he known this all up front, he wouldn't have gone through the heartache of, trying to figure out how to, get this house. So it was like a win because he was disabled. He didn't have to pay the upfront, funding fee, and all that got waived. So he had no monthly PMI. His rate was like 3.5% at the time.
And now being in the office, operationally speaking, I'll be, geez, John, you brought this loan in. He's not even a veteran.
Yeah.
And they'll blame it on John. They're going to restructure the deal. So then they're going to come out. It's going to be a new deal coming in.
Yep. Of course.
But that's what happens when, if a restructure of a file.
That's right.
It makes a lot of sense that, you want to give your customers the best deal that's out there. So,
right.
I mean, and then that's what we do as a company. That's what John does as a loan officer. So,
and I think, so we do have a lot of that stuff behind the scenes. We have to restructure and whatever. And so, a lot of times people will say, why do we need an extension on the commitment date? I thought this thing was a good deal, but, things happen along the way or things get discovered along the way.
Yeah, right. I mean, and it's, we're working for the consumer, right?
Yeah.
So, I mean,
absolutely.
A lot of times, 9 times out of 10, that loan's closing on time on a purchase and sale. Commitment date is met.
We're better than 9 out of 10.
Well, not on that veteran, right? Because you're going to have to restructure that one, right? I mean,
That's right. You got to call the
you
appraiser.
got to call the appraiser. There's a new appraiser for a VA loan.
Yeah.
So I mean, it does happen, but it's for good reason.
Yep.
It's not because we're just sitting on our thumbs and
And of course, for all you veterans out there, thank you for serving our country.
Yes, absolutely.
Absolutely.
Yeah, we have a golf outing there next week on veterans. Looking forward to that one.
Awesome.
Is there anything to being a first-time buyer that is beneficial? Is that something that you want to find out right away?
There's programs out there. So there's FHA is a wide range of program, and it really helps get people into homes, first-time home buyer. Then there's mass housing, right? So the state agencies that allow you to do 3% down as mass housing. Little stricter guidelines than FHA, but the mortgage insurance is, the interest rates aren't even as low as FHA, but with the MI decrease in payment, it's very close, FHA versus mass housing, to see which one's best. And then New Hampshire Housing actually has another great program as well. But, when someone comes in, you really want to see, what John's talking about, the I.C.E. is income, credit, equity. Once you have those, once you have that information, once we pull a credit report, it kind of tells a story of what program. It's not like way back in the day when you had all these different programs. Really, you're looking at state agency programs, FHA, and conventional. Obviously, if you're a veteran, you have that veteran. And if property's in like a rural area, you got the USDA program. But besides that, there's really
the Fannie Mae, the Home Ready.
Well, right, Home Ready,
You could allow
Home Possible, right?
They allow non-occupant co-signers where mass housing
And
doesn't.
they also have a decrease in the mortgage insurance.
That's right.
So I mean, the Fannie Mae programs, Freddie Mac programs, and the state agencies. You're right. So, but all of them have different income requirements. All of them have different credit requirements.
That's true.
Some of them. One of the programs is you can do lender paid MI. So if they put 10% down, say, we can actually factor in that mortgage insurance within that interest rate.
That's right.
So, school of thought is it's all tax deductible. Do I really care about that interest rate so much if it's going to be more on my payment?
Right.
The PMI, is that tax deductible?
Yeah, up to a certain income.
If you make up to about $100,000,
Yeah.
don't quote us on that, but $100,000, it's not. If you make more than $100,000, it's not tax deductible.
Yeah, and I know a lot of people are down on PMI, but what they got to remember is, like 30 years ago, if you didn't have 20% to put down, you were not buying a house.
It's true.
So you can't be down on PMI. It allows you to get into the house. It's leverage, especially people that bought a home 3 or 4 years ago. All of a sudden, they got an extra, $100,000 in equity for putting very little money down.
It's true.
It's
you want to get into that first home. You want to set yourself up on that first home before you want to start trying to build wealth through real estate. Because
Right.
that's really, that's the name of the game. People want to work less and make more.
That's right.
I know I do.
me too. Absolutely.
I think everyone just wants to work less and make more.
It's called being cool.
Yeah. That would be really cool.
The other thing too is,
But like I like to say on our show, there's no such thing as easy money.
that's right. Oh, there you go. That's right.
Snuck it in. I like that.
You like
I
that?
like that. It's very subtle.
It's very subtle.
The other thing too is like with the home ownership. Yes, you're going to increase the equity in your home over time, but it's the idea of being able to do it's your own home. You can do whatever you want. You can paint the walls any color you want. You don't have to ask permission. You get your yard. You can do whatever you want within reason, of course, but at least it's yours. And that's why
a condo seems very good to me right now, though. So you have no upkeep whatsoever. All right? So you can still do whatever you want inside the walls on the condo.
That's right.
I really want to go into a double wide. That's
I'll tell you.
I've seen some good double wides.
Yeah, I know.
Inside.
Easy living.
Yeah.
Easy money New England, easy living.
Yeah.
So Jonathan, you know a lot about home buying, don't you?
I'm learning.
You're learning.
I'm learning. You're my education, Brian.
So kind of looking at our show, what would you have as a question if I'm driving around or I'm really thinking about getting into the real estate world, buying my first home?
Well, I think that you guys hit it with that ice. I mean, it sounds like you want to make sure that your income is in order and that you have taken care of your credit score. And it really isn't difficult to keep good credit if you're just paying on time. If you don't have the money, that's a different story. You're not buying a house at that point. But if you have the money, make the payments on time or early, and so that you're not damaging your credit. And the one question I have is, if you end up having PMI and then the market booms and you have equity in the house, what does it look like as far as the refi?
Well, the refi is easy. You just get a you don't necessarily think you're going to refi. It all depends on, like, if you have a rate of 3.5% and the current market rate is 4%, you might want to reconsider.
You might want to talk to your servicer and say, hey, look, my house has improved in value. Can you drop the mortgage insurance?
Gotcha.
And most services, I mean, because I have a little history with this, typically, they're going to say, well, since you got the house, it's at least 24 months before you can kind of drop at the MI if the value increases. But if you're past that 24-month mark, you have a great first rate and you don't want to refinance, you definitely want to talk to your servicer.
Yeah. Or the other thing is, the Principal Reduction Act by our former President Bill Clinton says if you pay down the principal to 78% of the original purchase price, the PMI goes away automatically. So in other words, if you paid $100,000 for the house and you borrowed $95,000, when your mortgage gets down to $78,000, automatically.
But it's
78. I used $100,000.
Right. Oh, $78,000.
Yeah.
But that's not relevant today.
What do you mean?
Well, 78%. Like if it just doesn't go away, you still have to call. Make sure that the servicer knows that you're trying to drop the MI.
You can remind them that, but they have to let it go automatically under the Principal Reduction Act.
Well, based on the value that they already had, right? So not for a future,
not for future value.
Right.
No.
So only if they paid it down with that original purchase price.
Yes.
Right.
Yes.
So if they had another appraisal, you still have to go through that process.
That's right.
I got you.
What happens in the case of going upside down on your loan? If you all of a sudden the market crashes and you lose value on your house, do you have to put PMI on it?
No.
Or if you already have the loan, you're all set?
You're all set. All set.
No, you can't change the terms of your loan once you kind of go and you sign that at the closing table. So that's a good thing. I mean, you're not changing terms. You get a 30-year. What's important to know? It's today's day and age. It's a 30-year fixed rate. No balloon payments. No changing of interest rates. No prepayment penalties. That's a huge one, right? So you don't have to worry about paying it off. And when you get into an amortization schedule and you kind of see in the first 5 years what you're going to owe after the 5-year mark, it's pretty interesting to know that if you do have some disposable income and you do want to work on that principal balance, my opinion, I don't think it's a bad place to start is to start buying down your principal balance.
Yeah, if you could be in a situation where you get this huge bonus. Let's say you have a $400,000 mortgage, and now you get a bonus of $150,000. You pay it down to say $250,000. You could call the lender and say maybe you want now a lower payment, so they call it recasting the mortgage. So let's say you took it out for a 30-year mortgage, and 1 year you decide to pay it down. So they'll recast it over 29 years with the same interest rate. So it's a way of lowering your payment. Or if you want to just keep the same payment, you'll probably have a thing paid off in 15 years. It's whichever is more important to you.
And that's a real honest thing to say because a lot of loan offices wouldn't really tell you about a recast option because they want to do that refinance.
That's right.
Right? So, I mean, recasting is something that is definitely, if you're going to put down a lump sum and you want to recast, I believe every service is different, but, that person you're paying the mortgage payment to, if you're going to do that and you like your first interest rate, not a problem doing that.
Right. And if you get let's say you have a VA mortgage and you get a rate of 3.5, and then 10 years from now you decide you want to sell the house, that mortgage you have is assumable. So that new buy, it could be a way of let's say you're in a different market and now it's a buyer's market. You can say, hey, if you buy this house, you can, and let's say the rates are up to 5%. You say, we can give you this mortgage.
Fully assumable, right?
Yeah.
Yep.
And you'll have a rate of 3.5%. So it's just something to think about.
Yeah, I don't see too much of that.
No, you don't.
Yeah,
well, not in this where the rates are now.
Right.
No.
But it is interesting.
Yeah.
You can assume someone else's mortgage.
Yeah.
That's pretty slick. So with that being said, John, where are we on the? You could just say it.
43 minutes.
Wow, that's a fast.
Shame on me for trying to be professional.
Yeah.
Yeah, I mean, we're as professional as we can be.
All right.
I just came here for a cup of coffee.
Well, John, you gave us a lot of good information today, and this show isn't just for first-time homebuyers, but it's for everybody that's going through the mortgage process or wants to go through the mortgage process. A lot of times, people don't understand why we're asking for what we're asking for, and it's just try to give you enough information of why we're looking at the things we're looking at. I mean, like John said, it's complicating the mortgage process became complicated. It really isn't that complicated if you just keep it simple with that ICE.
Yeah, and you know who else should see a mortgage person is someone selling their house, because if they're going to buy something, what if they don't qualify for a mortgage? Now they're in trouble.
It's true. I mean, if you're looking to sell a home, I mean, it's a great place to start with a mortgage originator as well. You know, I mean, a lot of times they're just looking for that real estate agent, but they're not looking for that mortgage person as well.
That's right. So they, especially now, like everybody's, they're doing the refinance. I think 75% of the mortgages are out there are under 4%. So let's say you have 3.5%, and then I don't know, 2 or 3 years from now, the rate jumps up to 5%. To make a lateral move, I mean, that's going to add like $300 or $400 a month to your mortgage payment. That's if you did a lateral move. So now it's like, if you're going to sell, you got to really see what that's going to do for your payments, and that you're comfortable doing that. So again, it's the main theme is to see us first.
I agree with that. I mean, it's if you have a toothache, you go see a dentist. If you have house, you want to talk about numbers, you want to know how things work, you want to go to your mortgage person.
Absolutely.
Because that's who's going to break it down. That's who's going to tell you kind of the structure that you want to do it. And you want to know before you do something where you're not kind of backtracking.
That's right. I would say you'd want to talk to you guys before you even start looking for a house, because you want to know how much house you can get. And God forbid you look at a house that you could never afford based on your current credit score or
it's
income.
true. I've seen that happen quite a bit. I mean, I've seen people say, "Oh, I'm putting so much money down." Yeah, but just because you're putting down a lot of money doesn't mean that you can show that you have the capacity to repay based on that current mortgage payment.
I mean, that 10 years ago, that was definitely.
Yeah, but you had a big mortgage payment, it was like no problem. Even the local banks today, I mean, they have to prove the same things we prove, which is the capacity to repay and the
fiduciary responsibility.
It's called qualified mortgage. You have to prove that you have the capacity to repay.
Right.
So, with that being said, Google John Marroni. That's Marroni.
Yes.
And when you'll see John's picture there.
You can call me. You can get on my website.
And it's a great way to start the process. You'll get an email from John. You can actually apply right online.
And reach out.
Easy for you.
Right, and we'll just review your current mortgage options. The keyword is options.
And John's built quite a team. He has a loan advisor assistant as well as a marketing department. So he's definitely got all the bases covered.
It's awesome.
With that being said, let's bring a little bit of Rodney Dangerfield.
All right.
There's no such thing as easy money, people.
I was supposed to say that, right? So no such thing as easy money. If you have any easy money ideas, reach out to us.
It's a new day, it's a new way. Call 877-NEW-FED-1. It's a new way.
Hi folks, it's Brian Damico, owner of New Fed Mortgage, and I'm really excited to introduce Fast Track Mortgage, our new online system that gets you approved in less than 15 minutes. Whether it's a refinance or a new purchase, just go to newfed.com anytime, day or night, and click on the Fast Track Mortgage button. Fill out the form, and within 15 minutes, we'll approve your loan at the lowest rate possible. Don't waste time dealing with big banks. We're local and here to help you close your loan fast. Just go to newfed.com 24/7 and get approved in less than 15 minutes. Fast Track from New Fed Mortgage. Now that's a new way to get the loan you need fast.
877-NEW-FED-1.
Subject to credit approval, Equal Housing Lender, NMLS number 1881. Call us to the website for details.
877-NEW-FED-1.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Cafe, the United Podcast Network, its partners, or affiliates.